When a corporation needs capital, it has two choices. It can sell ownership or it can borrow. Selling ownership means issuing stock. Borrowing means issuing bonds. A bond is simply a loan agreement between the investor and the issuer. The investor lends money. The issuer promises to pay interest at a fixed rate and to repay the principal at maturity. That's the foundation of corporate debt securities, the other side of the capital structure. Each bond has three key features: par value, coupon rate, and maturity date. Par value is normally $1,000 per bond unless otherwise stated. The coupon rate represents the annual interest payment. So a 5% bond pays $50 a year, typically in two semi-annual payments of $25 each. The maturity date marks when the issuer must repay the bondholder the full $1,000 of principal. While the issuer is the borrower, investors can buy and sell these bonds long before maturity. Their prices fluctuate in the market as interest rates change. When rates rise, bond prices fall. When rates fall, bond prices rise. It's the fundamental inverse relationship that drives fixed income. Suppose a company issues a 5% bond while prevailing interest rates are 5%. That bond sells at par, exactly $1,000. If rates later climb to 6%, new investors can buy 6% bonds elsewhere, so the old 5% bond becomes less attractive. Its price drops until its yield to new buyers matches the market, below 1,000. That's a discount. If rates fall to 4%, the 5% bond looks better, and its price rises above 1,000. That's a premium. The nominal yield is the coupon rate printed on the bond. The current yield compares that annual interest to the bond's market price, interest divided by price. The yield to maturity, or YTM, is the total return an investor will earn if the bond is held to maturity, factoring in both the coupon income and any gain or loss between purchase price and redemption value. When the bond is callable, you may also see yield to call, which assumes the bond will be redeemed at the first call date instead of at final maturity. For a quick mental check, if a bond's price is below par, yields follow this order from lowest to highest: nominal, current, and yield to maturity. If the bond's price is above par, reverse it. YTM is lowest and nominal highest. It's one of those relationships the exam loves to test. Corporate bonds come in two broad forms: secured and unsecured. Secured bonds are backed by specific collateral. If the issuer defaults, bondholders have a claim on that collateral. Mortgage bonds are secured by real property such as buildings or land. Equipment trust certificates are backed by specific machinery, often rolling stock or aircraft. Collateral trust bonds are backed by securities the issuer owns, like shares in another company. Unsecured bonds rely solely on the issuer's general creditworthiness. They're also called debentures. When a company with strong credit issues a debenture, investors rely on reputation rather than collateral. If the company later issues subordinated debentures, those rank below other debt in a liquidation. Higher risk, higher potential yield. Some corporate bonds carry additional features. Convertible bonds can be exchanged for a fixed number of the issuer's common shares. They offer lower interest rates than comparable non-convertibles because investors value the conversion privilege. If the stock price rises far above the conversion price, the bond's market value increases as well. The conversion ratio equals the par value divided by the conversion price. For example, if the bond's conversion price is $20, each $1,000 bond can be converted into 50 shares of stock. On the exam, you may be asked to compute parity, the point where the market value of the bond and the converted shares are equal. You find it by multiplying the stock's current price by the conversion ratio. Callable bonds allow the issuer to redeem the bonds before maturity, usually after a fixed call protection period. Issuers call bonds when interest rates have fallen, allowing them to refinance at lower rates, much like a homeowner refinancing a mortgage. To compensate investors for that risk, callable bonds often offer higher coupon rates or a call premium above par. Put bonds work the opposite way. They allow investors to demand early redemption from the issuer, typically at par, if rates rise or if credit conditions change. Put features make bonds safer for investors, so they tend to yield slightly less. Bonds can also have sinking funds, where the issuer sets aside money each year to retire a portion of the debt before maturity. This reduces credit risk and supports the bond's market price. Corporate issuers may also create income bonds, sometimes called adjustment bonds. These pay interest only if the issuer earns enough income. They're often used in reorganizations and carry significant risk. A zero coupon bond makes no periodic interest payments. Instead, it's sold at a deep discount and matures at par. The investor's profit is the difference between purchase price and par value. Because there's no reinvestment risk, zeros fluctuate more sharply with changes in interest rates. All of these securities fall under the category of long-term debt. Short-term corporate borrowing uses other instruments, commercial paper, promissory notes, or bankers' acceptances, but those we'll handle separately when we discuss money market securities. Every bond carries credit risk, the possibility that the issuer won't pay interest or principal. Credit rating agencies like Moody's, Standard & Poor's, and Fitch evaluate that risk. Bonds rated BBB or BA and higher are considered investment grade. Anything below that, BB or BA and lower, is speculative, often called high yield or junk. On the exam, investment grade bonds are suitable for conservative investors. High yield bonds are for those who can tolerate risk. Corporate interest is always taxed as ordinary income at both the federal and state levels. Unlike municipal or treasury interest, there are no tax exemptions. When a bond is sold before maturity, any capital gain or loss on that sale is treated separately from interest income. Bonds may trade on exchanges or over the counter, quoted in terms of percentage of par. A quote of 98.5 means the bond sells for $985. Most corporate bonds use 30-day months and 360-day years when calculating accrued interest. Interest accrues from the last payment date up to, but not including settlement. For example, if a bond pays interest on January 1st and July 1st, and a trade settles on March 1st, the buyer owes 2 months of interest to the seller, January and February. Understanding those calculations helps you read the bond market's rhythm, how yields shift, how interest accrues, and why prices move even when the company itself hasn't changed. Behind every bond quote is a borrower and a promise. For corporations, that promise funds factories, payrolls, research, and expansion. For investors, it represents predictable income and defined risk. Stocks tell you who owns a company. Bonds tell you who it owes. Together, they describe the entire financial heartbeat of modern markets. When you see a bond table or a yield spread question on the Series 7, remember that relationship. Rate up, price down. Premium bonds yield less than coupon, discount bonds yield more. Those few sentences explain nearly every pricing question you'll face. Bonds are promises in writing: interest, maturity, repayment. And understanding them means you can read the language of leverage, stability, and trust that keeps every corporation running.